How many cuts then can we get in 2025?
So I think the Fed will be doing 50 basis points in September.
Whoa.
And I think,
really?
yeah,
Okay, you're the first person I've interviewed in the last, I don't know how many months, but okay, let's talk about that.
They basically had to do 25 in July. They know they had to. Look at the labor market today. Look at inflation today. But they skipped the meeting. They skipped it.
Alfonso Peccatiello returns to the show. He is a founder of the Macro Compass, and we'll be talking about what's next for the economy, for the stock markets, bond markets, and what to expect for the Federal Reserve next week. They are expected to cut. How many cuts will they execute over the course of the next couple of months? We'll talk about that with Alfonso. Welcome back to the show.
Hey, David. Such a pleasure to be here every time. Hope you're doing great.
I'm doing well. Hope you're doing well as well. You just got back from traveling, so welcome back to work, I guess, which that's the theme for everybody. Welcome back to work in September. You're also launching a hedge fund soon, so we can talk a little bit about that. And that is the theme of our discussion today. If you were to get into the markets, if an investor were to get into the markets this quarter, and I know your fund officially starts next year, if you were to get into the markets this quarter, what are some of the major themes, investment themes, we need to be paying attention to? What are some of the sectors you should be overweight, underweight? Let's start there. Your general macro thesis for investing in Q4 2024.
Mm-hmm. So let's start from a bit of an unexpected place. China is imploding. So we get every week new information from China that points to a material slowdown, and the policymakers are not trying to really stop the bleeding here. It seems like a centrally planned deleveraging that started from the real estate market in China, and it's now spreading as well to consumers. So, for example, today, if you look at the iron ore contract, so iron ore is one of the main commodities used for the production of steel. And China is huge in the usage of steel because of their big infrastructure projects and real estate projects. The iron ore contract has gone down 39% year to date, and it is now sitting at the weakest level in 2 years. So if China was trying to do something, David, at least, to stop the bleeding in the real estate market, you would see stuff like iron ore and steel contracts going up. You will see the housing market somehow stabilizing, and it is not doing that. China is slowly but surely imploding.
To what extent does this slowdown in China, we'll talk more about that, to what extent does that have played a role on lower commodity prices, including copper, steel, for example, palladium, platinum?
Yeah, a very big role. China is one of the biggest sources of demand for many of these industrial commodities around the world. Exactly the ones you mentioned, actually. Iron ore, steel, copper. And the fact that China is applying actually the wrong policy to try and stop the bleeding, the deleveraging of the housing market, actually says a lot about their real intentions here. So if you take a step back, when China joined the WTO, China prospered a lot by accessing new markets, right? And getting this new free trade world access, basically. And so they gained market share, and China was growing organically. It was doing great. But then at some point, this marginal positive effect was over. So what they tried to do to keep up these very high GDP growth rates was creating debt, using credit. So they started building up this credit and this debt and this leverage in the economy and became more and more and more leveraged. And at the beginning, this produces great results. But at some point, as you become more and more indebted, it starts to get hard actually to get returns out of new credit. And so at some point they thought, well, let's actually try and use the real estate market to generate wealth, to make the average Chinese person wealthier. Because contrary to developed economies in China, the average worker wasn't really getting compensated for China becoming richer and more powerful. Chinese wages really weren't going up in real terms. And so they used the real estate market to make Chinese people feel wealthier, but there is clearly a problem there.
I want to take a minute now to talk about different ways to invest in silver. As you may know, silver has been one of the top performing asset classes in the first half of 2024. So how can we leverage silver's gains? I'm here to tell you that today's sponsor, Kootenay Silver, has great leverage to the silver price. Kootenay has a leading growth profile highlighted by one of the largest junior-owned silver asset bases in Mexico. The company has a 20,000-meter program underway at the high-grade Columba silver property to conclude in the maiden resource. Kootenay is holding over 200 million ounces in the measured and indicated categories at the company's Promontorio and La Cigara projects. The company has an experienced management team with a track record of success from exploration, discovery, finance, and production. If you're looking for a company that will leverage the potential gains of the silver market, do your due diligence on Kootenay Silver, ticker KTN on the TSXV. Learn more about the company in the link down below or scan the QR code here. Well, historically, the West has used Chinese-made goods. It's not so much the opposite where the Chinese have been consuming Western-made goods. So bottom line is, why should we in the West, North America, and or Europe care about a slowdown in China?
Well, what's going to happen is that China is going to be exporting deflation to the rest of the world. So what happens is that China is basically the manufacturing hub of the world, right, David? They basically produce, as you correctly said, most of the stuff, most of the goods, especially that we use in this side of the world, in the Western world. Now, if you look at Chinese inflation numbers, you already see effectively deflation in China becoming entrenched. Okay, so what you see there is a deleveraging. The economy is imploding in itself. And what happens at that point is that the Chinese weakness will basically spread over to the rest of the world through lower growth, because China is less able to basically keep up with the production that the Western world needs. And also you will be seeing an export of deflation around the world. Now, generally speaking, what China used to do in the past to try and offset this was to weaken the Chinese currency. So in 2015, if you remember, what China did was they devalued their currency almost by surprise, right? But ask yourself, what if China would do the same now? If China would devalue the currency right when the economy is slowing down so aggressively, and if China would devalue the currency to fight what? The real estate deleveraging. How does devaluing your currency help if your housing prices are going down? It doesn't really help. What will be the message it will be sending to the world right now? A very negative one. So I don't think China wants to devalue the currency. I think China, therefore, will continue having downward pressure on its economy, and this will have a negative impact, specifically on certain economies that really depend from China, like Australia, Brazil, Canada as well, where China is a big investor. China exports a lot of capital away in places like Australia and Canada. And actually, you will see, I guess, the negative spillover effects coming from China. But in general, it's the second biggest economy of the world. And when it deleverages, when it deflates, when it slows down this aggressively, there are always spillover effects in commodities and in other economies.
They cut their overnight rate. The Bank of China has cut their central bank rate by 10 basis points in August. Can we expect more of that going forward?
Yes. And they're applying the same recipe that Japan applied in the 90s, if you remember. When the real estate bubble burst in Japan, what policymakers did is they didn't come in with fiscal stimulus. They just cut interest rates more and more and more. So 10-year Japanese government bonds went from 9% yields to 1% yield in 10 years. But what did it do to stop the bleeding in the Japanese real estate market? Nothing. Because what happens is, if you're a developer and you're defaulting, if you're an investor, like a Chinese person who has bought the first and the second apartment, wanting to participate into this Chinese wealth illusion story that the housing market's going to make you rich. Well, if you're defaulting on your loans, if you're defaulting on your construction projects, what is lowering interest rates? What is it going to do to you to help you? Not much, right?
Let's just step away from China for just a bit before we come back. So the Chinese central bank has cut rates. The ECB in Europe, where you live, has cut rates. The Bank of England has cut rates, and where I live, the Bank of Canada has cut rates. It's expected the Fed is now going to start cutting rates everywhere around the world, except for Japan. They've been cutting rates. What does this mean? More global liquidity?
So central banks are cutting rates this time, not proactively, but reactively. So what's going on, David, is they're looking at the economy slowing down, and they're saying, oh, whoa. We were too tight for too long. Now we really need to cut interest rates because we are afraid now that the labor market might slow down too much, that we might smell recession in a couple of quarters. But this is a reactive cutting cycle, not a proactive one.
Bond traders, if you're looking around the world at every single central bank, again, except for the Bank of Japan, which has been hiking rates, where are the best opportunities if everyone's cutting rates?
Yeah. So look, as a bond investor, what you have to do is not only, if you buy bonds, not only expecting the central bank to cut, but to make money, you have to expect the central bank to cut more than what the market is already pricing in. Okay. So you have to look at what's priced in the market today. In the US, for example, there are 225 basis points of cuts priced for the next 2 years. In Canada, something similar. In Europe, a little bit less. So you look at what's priced in markets around the world, and then you say, what is the bond market that is offering me the best opportunity right now? And if I look around the world, there are two bond markets I think that are better positioned than the US bond market to perform better: the European bond market, the UK bond market, and the Australian bond market. And why is that? Because these central banks are priced to cut interest rates, but they're priced less aggressively than the Fed. So now let's think together. Europe, the UK, and Australia are all economies that, for some specific reasons, are more vulnerable to this economic cycle than the US is. For example, in the UK, you have variable mortgage rates, short-term resets, a bit like in Canada, basically, right? And so these high interest rates we have had so far have flowed already to hit the households. So the households have already had to basically get the burden on their shoulder of higher interest payments. So they're suffering more. The economy is slowing down. And so this means that going forward, well, these central banks should be cutting more, not less than the Federal Reserve. And then you have a case like Australia where, well, the economy will be heavily impacted by Chinese slowdown, heavily. China is the biggest importer of Australian-produced iron ore. Well, then guess what? If China is not demanding any iron ore anymore, the Australian economy will also slow down, and this will require the Bank of Australia to cut rates more.
Okay, if we're expecting other central banks to cut more than the Fed, can we also expect the dollar to appreciate versus a basket of other currencies?
Yeah, so I'm a bit of a contrarian on the dollar right now. Everybody thinks that because the Fed is going to cut, the dollar has to weaken. And I don't agree there, because it's always the dollar versus what, right? And here we're saying the dollar versus Canadian dollar, the dollar versus the euro, the dollar versus the sterling. And against these currencies, I think the dollar will be doing fine for two reasons. First, because I expect the central banks to cut even more than the Fed. And second, because if the world is slowing down, people always forget that outside foreign countries are indebted for $13 trillion with dollar debt. So you have Brazilian corporates, Chinese corporates, corporates around the world. They have borrowed in dollars, David, okay? So they cannot print dollars. They're not the Fed, right? But they have borrowed in dollars. So what happens if the world slows down? Well, they cannot get their hands on newly created dollars because they cannot sell commodities. They cannot sell services so fast because the economy is slowing down. And so what happens at that point is, if they don't get enough inflows of dollars, but they have $13 trillion of dollar debt they're sitting on, they will have a problem repaying this debt. And so the dollar will actually go up in value because the system implodes on itself. And therefore, the dollar, which is the denominator of this system, actually benefits from such a squeeze when the economy slows down. So I'm not so negative on the dollar, actually.
Okay, so not bearish on the DXY. On the dollar, let's turn to this story. This is what former President Donald Trump and, of course, Republican frontrunner said about the dollar. He said during a rally in Wisconsin on Saturday, he said that many countries are leaving the dollar. They are not going to leave the dollar with me. I'll say, you leave the dollar, you're not doing business with the United States because we're going to put 100% tariff on your goods. Okay, so let's assume he wins and he does this. Which countries are affected? Which countries will get 100% tariff on imports?
So all countries that have basically voiced trying to leave the dollar system, the euro dollar system. So you have the BRICS, right? You have countries like Brazil and India and China and even Saudi Arabia to a certain perspective, South Africa. They've all tried to basically find a solution to escape the euro dollar system, right? They want to transact with each other, not using the dollar, but using their domestic currencies. And these are the countries that are going to be targeted the most. So a country like India, for example, which is making bilateral transaction with China, not in dollars, but they're making it in Indian rupee or in Chinese renminbi. These are the countries Trump is talking about. These are the countries that he wants to penalize. And so what happens if he puts 100% tariffs? I mean, this is very, very big. But if we put any sort of big percentage tariffs on these goods, well, guess what? They are going to become less attractive. And so the dollar is going to strengthen against these currencies. So politics is something we didn't discuss, but it's another reason why the dollar could actually strengthen, not weaken, and surprise many people.
Well, yes, Donald Trump does want a much stronger dollar. And he also wants a lot of the manufacturing to be brought back to the US, which I guess, these two theses are complementary. What is the other country going to do, the counterpart, if let's say Russia or China, India, doesn't matter? What will they do in response to a 100% tariff slapped on their goods?
I'm going to think about retaliation of some sort. So this is the repeat of 2018, right? What Trump tried to engineer with China. So you saw that every time Trump tried to target new basket of goods or new tariffs on China, you had some sort of retaliation on the other side. And look, let's discuss about what this does in general to the economy, right? Because if you're applying tariffs, and the other country retaliates, what's basically happening is that the trade flows will be slowing down, David, right? I mean, basically, we'll be transacting less and the world is going to slow as a result of that. But what's going to happen is that you're increasing the price of exported goods. You're applying tariffs on them, right? So the price is going up. So you're effectively importing inflation as well. And let's not forget that basically you will be looking at a situation where the economy slows down in real terms. You are applying tariffs on goods, so inflation rates move up. And on top of it, the third thing that Trump wants, he wants a strong dollar, but he also wants lower interest rates. He has been very clear. He wants to pressure the Fed to lower interest rates. But if the Fed lowers interest rates while you're applying tariffs, which is an inflationary policy, David, what happens to the bond market? You're basically taking 2-year yields and you're saying, let's drop them, right? Because we are going to force the Fed, basically, or influence the Fed to cut interest rates. But inflation is going up. So the back end of the curve is going to steepen a lot. The yield curve is going to steepen a lot and very aggressively so. And assets like gold, for example, they will be benefiting from this big times because the best environment for gold is an environment where you have the central bank keeping interest rates low, but you have inflationary pressures building. And so the market is looking for a release valve, okay? They're looking for assets that do well when inflation picks up, but monetary conditions are loose. This is exactly what Trump is trying to engineer here. So while he wants a strong dollar, and I think he's going to get a strong dollar against the euro, the Indian rupee, etc., he's also probably going to get gold prices going up by a lot.
Typically, gold and dollar move inversely, do they not? So here
Yes.
we're going to get both going up at the same time. How is that possible?
Well, it's possible because the combination of policies I just described is very, very rare to get, David. Very, very rare. Normally, if you're having on the politician side inflationary policies, well, the central bank will be hiking interest rates, right? And here I'm talking about a situation where the central bank will be influenced to keep interest rates going down while we are applying tariffs, we're applying inflationary policies. So this very, very rare combination of monetary and fiscal policies and foreign policies as well will actually lead to a situation where the dollar is going up and gold is going up. So think about it. Gold priced in euro, gold priced in Canadian dollars, gold priced in Indian rupees. It will go through the roof in this case.
Let's talk a little bit about the future of deficits in the U.S. According to a Penn Wharton model, which projects out the future of the deficits in either a Trump win or a Harris win. It's been projected that either scenario would mean higher deficits, with Trump being a little bit more. So this report found that his plan to permanently extend the 2017 tax cuts would add more than $4 trillion to deficits. And for the Harris analysis, it showed that her plan, in regards to expanding the child tax credit, for example, earned income tax credit, basically tax credits, that would also add to the deficit by the order of $2.1 trillion in the coming 10 years. So Trump's plans for taxes and fiscal policy, slightly more for the deficit, but either way, we're getting an expansion of the deficit. What does that mean for inflation and ultimately markets?
So what this means is basically you have a government that is injecting more money into the private sector, David. And the government is injecting this money regardless of the state of the economy. They don't care. They're going to be doing deficits at a very large pace, whatever the economic cycle is. So what does this bring? Well, it brings a couple of things. The first is that inflation is going to be structurally higher. growth is going to be structurally higher. It doesn't mean you're not going to get cycles. You're still going to get cycles. But because the government is there injecting a ton of money at each time, you're going to basically give a tailwind to the economy and to inflation much more than you had over the last 10 years. But this also brings a lot of volatility, like a lot of it. Because why is that? Well, imagine the economy is already running relatively hot. Let's say you're in a good business cycle, okay? And you keep doing this deficit. Every year you do 1 trillion, 2 trillion, 1 trillion, 2 trillion. So what happens at some point? Well, you overheat the economy, don't you? You throw more money on an already hot economy. So what's the result of that? Very high inflation. So what's going to happen then? Well, probably the central bank is going to have to hike interest rates. And what happens? Well, what happens now? So the labor market slows down. So the macro cycles are going to be much more volatile going forward, much more volatile. So people that are counting on, I'm going to buy some stocks and stock market always goes up in a straight line 10% every year with very little volatility like we had in the past decade. I don't think that's enough anymore as a strategy if you're an investor.
By the way, let's talk about the Fed now. If the rest of the world is slowing down and China in particular is going to import deflation, like you said, doesn't that do a lot of the jobs, the Fed's job for them, right? They no
Yeah.
longer need to cut rates as much.
Well, so far so good for them, right? They've benefited from this China exporting disinflation to the US. Goods inflation in the US is negative already, David. So we are basically having prices of goods going down, and that's because of China. So we are already getting this tailwind, right? And the Fed has enjoyed it so much. It's been fantastic. But what they've done is instead of started cutting rates a little bit earlier because they saw the first signals of the labor market weakness, but they chose to ignore it. They've waited until now. And now what's happening is that we are creating, the US private sector is creating only 96,000 jobs a month on average over the last 3 months. 96,000 jobs is the weakest pace of job creation in the US since the summer of 2007. Okay, so we're looking at a very weak pace of job creation, and there's going to be revisions. They're going to be revised down probably as well. And the Fed has cut so far 0 times. So the Fed is falling behind the curve. They've been too negligent. They've sat on the situation where they were getting the tailwinds from Chinese disinflation being imported in, but they've not proactively cut interest rates. They've waited, in my opinion, they've waited a bit too long.
How many cuts then can we get in 2025? Ultimately is what people want to
So I
know.
think the Fed will be doing 50 basis points in September.
Whoa.
And I think,
Really?
yeah,
Okay, you're the first person I've interviewed in the last,
well,
I don't know how many months, but okay, let's talk about that. I should have led with that this interview. Okay.
well, I mean, as I said, I'm an investor. And for me, it's all about finding a symmetry. If everybody's pricing 25 basis point, David, like it is
Right.
today, well, you might get a chance to do quite big returns if they go with 50. So it's about losing a little bit in your bets and trying to make a lot if you're right. But look, why do I think they do 50? Very simple. They basically had to do 25 in July. They know they had to. Look at the labor market today. Look at inflation today.
Yeah, they
But they
even
skipped the
said
meeting. They
they
skipped
even
it.
yeah.
Go
Yeah,
ahead, sir.
you're right. No, I was just gonna support your view. They even in the July meeting minutes, it was revealed that they had considered it. But yes.
Yeah. So they had considered doing it. And now they have information that basically tells them, hello, dude, you should have done it. Right. And they haven't. So now by doing 50 basis points, they can basically catch up on missing July. And also the other thing, there is no meeting in October. The next meeting is in November. And if you see the pace of deterioration of labor market data and you only start with 25 basis points, you might be forced in November to come in big right a few days after the election. How is that going to look? How is that going to look? It's probably much better to do 50 basis point now, catching up on the old July missed opportunity, and then you can look at November with a bit more calm. I think there is a chance they do 50 basis points.
Yeah, for sure. Maybe the chance is not zero, but that's definitely a chance. What does that do to the markets, though? The markets are pricing at 25 with the highest probability. Are we expecting a big surge in stock markets then?
Yeah, I would say if they do 50 basis point and they're smart with their messaging, because the risk here, David, is that they do 50 basis point and the market freaks out. It's like, holy crap, the Fed is doing 50. They know something we don't know. There must be something really bad going on here, and they freak out. Instead, if they're smart and they do 50 basis point and they communicate just what I told you, which is basically, hello, guys, we're just catching up on missing July and we're doing 50 to basically to offset not cutting in July. But now we're going to move gradually. I think in that case, yes, the stock market will be moving higher. But it's one of these moves that are always interesting because if you have noticed now, what has happened recently is that when the stock market goes down, in a day where Nvidia loses 9%, remember it happened a week ago or so, bonds actually make money. Yields actually go down. So the correlation between the stock market and the bond market has finally moved to negative again, like it used to be. And when it moves negative, it means that investors are starting to see bonds as a hedge, as a protection for their portfolio. And bond investors are, generally very attentive to macro conditions. So this switch of correlation is quite interesting.
You have a chart here actually showing, I guess, Fed cuts in prior cutting cycles and what the bond market has predicted in the past. And you wrote about this recently. The bond market is sending a loud message. What is the bond market signaling right now?
We have a lot of cuts priced in over the next 2 years. As that chart shows, the market went and priced almost 250 basis point of cuts over the next 2 years by the Fed. So a lot of people are now saying, yeah, that's too much. The bond market is wrong. So what I did is I looked back 35 years to 1989. And I looked at every time the bond market was very aggressively pricing cuts, like today, okay? And I wanted to check whether the market was right or the market was wrong. So there were 6 instances where the market was very, very dovish in the past. And what ends up, if you do that analysis, what you realize is that, well, in many occasions, the bond market was actually right. And the Fed actually even ended up delivering more cuts than what priced in. So like in 2000 or in 1990 or in 2007, the bond market was dovish. It was pricing like 150, 200 basis point of cuts. And the Fed ended up delivering 400, 500 basis points. So it's true, the bond market is very aggressively priced today, but generally it is so for a good reason.
I want to shift gears now and talk a little bit about Europe because the European economy is obviously very important as well. It's been reported that Germany, I'm just taking Germany as an example, it's the largest economy in Europe. Germany's inflation is now at the lowest level in 3 years.
Yeah.
I don't know if that's good or bad because, lower inflation can mean more consumer spending. How are you reading this?
Well, it's good until a certain point, right? We're switching basically to that point of the cycle where bad news is bad news, actually. That's quite the news. Bad news should be always bad news, but there's always a cycle where bad news is good news because, we're just decelerating a bit and the central bank has our back. But now bad news is bad news because you're getting so late in the cycle that bad news might actually mean recession. And so what happened today is that not only German inflation is very low, which is a sign of economic activity slowing down a lot. In Germany, you have industrial production, which is going down. Retail sales spending from German consumer going down. You have really situations where the German economy is slowing down, both real growth and inflation really, really aggressively. News of the day, Volkswagen and BMW, the 2 largest German car manufacturers, are either closing German manufacturing plants altogether or they're terminating contract by the end of the year. So that's quite a sign, isn't it, David, that the German industrial machine is suffering big times. It's not competitive anymore. The business model is broken.
This reminds me of campaign promises made by both Trump and Harris, who want to fight inflation. They've made it a priority for their economic policies to fight inflation. That's what Americans still care about. How do we do that without having a situation like in Germany and some parts of Europe where we have a recession, right? Recessions are inherently disinflationary events. So forget engineering a recession. How do we do that? How do we bring down inflation without causing massive unemployment?
Well, so far the job was pretty decent because we have brought inflation down in the US. It's still high, but it's less high than it was before. And until a few months ago, the labor market was still somehow holding. So at that point, David, but I'm looking now 4 or 5 months ago, central banks should have said, well, we're doing good. Let's cut interest rates proactively, not reactively, so that we help the economy stabilize. But instead, unfortunately, they've done the opposite. They've waited and waited and waited and waited. And now we're in a situation where, well, they got to hurry. They got to hurry and maybe be even lucky that they come in early enough to stabilize the economy. And honestly, Yeah, well, the odds are not so high anymore. So, well, it's easy to say what they should have done. So I can now talk only about what they will do, in my opinion, going forward, which is they will cut interest rates quite aggressively.
What about for the government side? So Trump has promised to drill more for oil, which
Yeah.
his thesis would bring down, he wants to bring down the oil price, which is an important input component for everything. That would bring down inflation. For Kamala Harris, she plans to do several things, including increasing housing supply, making
Mhm.
housing more affordable, would somehow also bring down inflation, right? Can you evaluate some government policies that may be
Yeah.
effective?
Both of them work on the supply side, right? So what they do is they increase the supply of scarce resources. Trump wants to increase this American supply of oil, right? And Harris wants to increase the American supply of housing. Both of them are disinflationary policies. Both of them are actually policies the U.S. will benefit from. So it's always, a nice job to, um, throw a bit of heat on policymakers, be them politicians or the Federal Reserve. But in this case, both policies would actually be positive. So sometimes on politics, you have to take a step back, I think, and not, try to assess rationally. Those two policies would both be disinflationary and I think positive for the US consumer.
My last question on Europe, I've gotten the viewpoint that it's probably in the Europeans' interest to somehow dissolve the EU if countries could manage their own monetary policies. You're actually living in Europe, so what is your view on this?
Europe in its current structure shouldn't exist, David. I mean, it's very simple. You have taken 19 very different economies. You have put them all under one fiscal umbrella and one monetary policy umbrella. I mean, who would have ever thought this is something you can do? It's very suboptimal, very suboptimal. So, like, you have one central bank that says the interest rates should be, I don't know, 4%. And then 4% maybe works fine for the Netherlands or Germany or Finland, but it doesn't work for Greece or Spain. It doesn't. It's very different from the fiscal perspective. They might want to do something else. So what happens is that you can try and put the pieces together when the global situation is okay. You muddle through, but when every time there is a crisis at a global level or in Europe, you will always have a very very suboptimal set of situations to face. So what if you dissolve it now? Well, that's also a problem because each of these countries are creditors and borrowers to each other. So there is something very complicated here going on. And the Italians effectively and the Greece and the Spanish, they owe to a certain perspective to the north of Europe a certain amount of money as well. And so it's not that easy anymore. And the northern part also depends on Southern European economies to do well, to continue to thrive. So now it's almost an impossible situation, frankly.
Is there any risk of a debt crisis like we saw in
Yeah.
Greece in 2009?
Well, look, I think the difference is that the central bank now understands they have to intervene, and they have to make sure that if the market freaks out, they basically will do QE. And that's again a very unstable situation. You're counting on a central bank to backstop and to basically kill any market signals. Every time investors get nervous, you're going to have a central bank coming in. And for the currency long term, that's not great. For the confidence of foreign investors as well, that's not great because it's not a free market anymore.
Well, let's close off and talk about your work. So we mentioned you have a fund coming up. Tell us about that. What is your strategy there? What can potential investors expect from you?
Yeah, it's a global macro hedge fund. So what I'm launching is a strategy that basically is very diversified to the rest of the market. So it tries to provide good returns when there is a lot of macro volatility going forward, which is exactly what I expect because of changing demographics, the use of deficits, politics, geopolitics. I think there's going to be a lot more of macro volatility, and this strategy tries to take advantage of that.
Macro Compass, any updates to give us there?
Well, the Macro Compass is my research business where people receive macro research every week from me. So what I'm offering now is a free trial. I just say, guys, if you like this interview and you would like to take a look at my research for a couple of weeks, it's completely free. So we're going to put some form below, David, maybe below this show here, where people can just go and fill in. It takes 2 minutes, some basic information, and you will be on board to the free research. Take a look. Maybe you enjoy it, and maybe you want to become a subscriber.
Get a deeper insight into Alfonso's thoughts, obviously, would be the advantage there. So, yeah, we'll put the link down below and make sure to follow him there. Thank you very much for your thoughts today and your analysis. We appreciate it. See you next time.
Yes. See you guys.
And thank you for watching. Don't forget to like and subscribe.